All right, guys. Thank you for logging on today. We've got a really interesting topic. This is something that I think you're really going to enjoy. It's something that we don't talk about very much. And so I think that it's important to understand because it's something that's going to affect your relationship with your bank. And that is, how is your banker getting paid? Um, I'm your host, Besim, and we've got Adam Boz on the line as well. Adam, how you doing today?
Doing well, sir. How are things with you?
Good. I'm really excited for you to tell us how much you're making and how you get paid.
Sure. Yeah. Let me get my pay stub. I'll be right back.
Oh man. But yeah, this is an interesting topic. It's funny because we have a lot of people that want to be bankers, for example, as well, and they don't even understand how they get paid. And there's people that I think it's important because you see uh, where people's uh, motivations lie,
hmm
depending on how
Well, and
they
differs so much too.
yeah.
There is no one template for different banks and different bankers and how they get paid.
That's true. That's a true statement. And I think that, every single bank does it slightly differently. And there's even different divisions within the same bank that pay
hmm
people differently, depending on how
Absolutely.
they do their stuff. But what I kind of want to get across kind of through here is I want people to kind of understand what's motivating a banker for the most part and how do they get paid. And what's funny is I have actually had clients ask me how I get paid, and I think it's a very smart question to ask. Like the first couple of times that it happened to me, I was very surprised and I wasn't really sure how much I should divulge, but I kind of talked to them a little bit more, and I got that they are trying to understand what my motivations are and how I'm willing to help them and where my advice or my discussion was coming from. And I think once they had a better understanding of how I was paid, they were actually surprised and liked it a lot. So, okay. So, Adam, you've worked at multiple banks. I've worked at
hmm
multiple large banks as well. And we've seen a lot of different pay structures. Let's kind of talk from the beginning. What are the major components of how you see people getting paid?
Sure. The major fundamentals that you see, generally speaking, is a salary base.
Mhm.
And that's what you get paid, the day-to-day paycheck a couple times a month. And then you have the incentive structure. And the incentive structure is really where you see a lot of variability, where there's annual incentive, so what you've done over the accumulation of the year. And then
Mhm.
there's individual commission-based incentive, where either on a per deal basis, monthly basis, quarterly basis, an additional amount of money is paid out based on performance for that period of time. And there's extremes to both of those. There's jobs where it's 100% kill what you eat,
Yes.
and you get no base salary and you're 100% commission based. And there's jobs that are largely skewed to the salary end of the spectrum with a little bit of incentive at year end. That being said, I think that also skews how certain bankers adjust and attack and work with certain clients, because it's predicated on them getting paid or not. And so there's two ends of the spectrum. I think the happy medium is, generally speaking, a salary base with some incentive built in.
Yeah. And so I think you're right. I mean, like let's go to the first extreme, which is everything's getting paid based on what you kill. It's almost
Mhm.
all commission based. I see very few banks doing this. I have seen a bank actually do this before, but it's very rare actually. But what that is going to do to a bank, and the reason why most banks don't do that, is it's going to have the banker try to push every single deal through, regardless of if it's a good quality or not.
Mhm.
And
Mhm.
that is something that the banks don't want because generally your deal might not go bad the first year. And so if they're paying you on a deal that 3 years from now goes down, goes bad and loses a whole bunch of money, you know, that's not good for the bank because they've already paid you on that and they're losing money on the deal. And so, you see very few banks actually paying just a straight commission structure because they want to balance both the incentive to go out and get business, but you also need to protect the bank and make sure you're bringing in quality deals, quality companies.
Correct.
Okay.
Right. I think that also changes a banker's approach when it's full
Yes.
commission based, because this is every bit of a relationship, and there really has to be the best interest of the client in
Yeah.
mind. Yes, it's great. We all want deals. It's how we get judged at the end of the year. But when your incentive and your interest is derived solely from booking a deal, I think that works counterintuitive to the best interest of the client, because we need to work together. The bank needs to protect its interest, but you also have to have the client's interest front of mind. What are
Yes.
the goals and objectives? I'm not just trying to sell you a product. Is this the product you need? Is it the product you want?
Yeah.
Is this best for your goals? That's the type of conversation you should be having. And that should be ultimately what guides a deal going through or
Yeah.
not.
So let's from one extreme, let's go to the other extreme, then we'll come back to the middle and talk where most banks lie. So
Sure.
the other extreme is they're not paying you any commission. Everything is a base salary.
Correct.
And what happens in that position is that banker has no incentive
None. Yeah.
to grow the business, no incentive to bring you new ideas, no incentive to bring you new solutions, no incentive to help you grow. He's just basically sitting there managing a book, answering phone calls, doing administrative work, making sure that, you know, your day-to-day stuff is taken care of,
Hmm.
but doesn't have that incentive to grow. And so
There's no
I
personal
actually,
touch.
yeah, I actually have only heard about this happening in rare occasions, similar to, let's say, like Wells Fargo. Okay, so Wells Fargo went through this huge situation where basically they had their retail bank, people were opening up accounts. They were kind of almost skewed the opposite way, where everything was based on commission, and so they had all this pressure, sales pressure, and because they were basically now getting hammered by the government, they're saying, okay, well, we're going to skew it the exact opposite way, and we're just going to work on customer satisfaction. You're not going to have any goals based on sales at all. And so I saw that, and that's usually just a temporary reaction. It's kind of like, let's calm things down for a little bit. That might happen in a situation like now where COVID's going on, and it's like, just take care of your clients. Don't worry about sales, you know. But usually that's not a long-term structure. They're usually want to have a little bit of a balance between both, you know, having a base salary where you're doing what's right for the bank. You know that you're going to get something no matter what, because you're doing what's right. You're managing the asset quality. You're there for your clients on a day-to-day basis. But they also want to have some sort of growth engine and something that sparks you to get things done. So that's where I think most of the banks lies. It's a good medium. And usually what I see in commercial bank, at least in small business banking and commercial banking, is you'll have a base of X, and then the bonus, I've seen it go from anywhere from, you know, 20% of your base all the way to 150, 200 times your base.
Hmm.
And so it's kind of a large range, but it kind of depends on the bank you're at and how it works. What I've seen, another thing that's really interesting is I've seen there's two types of banks, one that do it more subjectively and then ones that do it formulaically. And so I've worked at a bank before where everything was exactly by the number. You did a deal for X, your margin was Y, and 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 this is how much you're going to make as a percentage of that. So the more profitable the deal that you did, the more you would make, and et cetera. And you know, in some ways, it's good for the banker because they know exactly when they sell a deal what they're going to get off of it, you know, or exactly what it is. But at the same time, I mean, I guess from the bank perspective, it's good because also the more profitable the deal is, you know, the more the banker's going to get. But at the same time, you know, from a client's perspective, I think it pushes them a little bit more to kind of dig for an immediate win, you know?
Right. Yeah,
Uh,
I think the deals you're going to find on that end, when it really is somewhat formulaic, which I do like, because it's black and white. You know what it is and you know what it isn't. But I definitely think that's going to be at a greater cost, because ultimately you're impacting a paycheck.
yeah, I agree. Another thing I wanted to kind of point out when it comes to this is, since so many banks have a large portion of incentive coming from, I mean, large portion of pay coming from incentive or bonuses, most bankers are going to work really hard to get your deal done. So although they might be delivering you the message that I can't get your deal done because of X or Y, I guarantee that banker has been fighting with their credit team, fighting with their risk team, trying to get this deal done. They're doing what, I mean, they want a yes. The banker is your advocate. They want a yes. They want to make sure that you get this deal done because it's going to help them. You know, so, you know, they frequently, getting put in the position where they have to deliver a message that they would wish they didn't have to deliver,
Mhm.
but it's to protect the bank, and we kind of play this middle ground of protecting the bank, but also advocating for the client. But I guarantee you, most bankers, they want to get your deal done. They're not telling you no because they don't want to get the deal done. It's
Right.
because
Right.
they have to fit your deal within this risk framework, and maybe something's not fitting at that particular time. But this incentive structure, bankers are wanting to get your deal done. I don't think I've ever met a banker that doesn't want to get a deal done.
Right. Otherwise, what are you doing? You're wasting everyone's time.
Yeah.
Of course, we want to be your advocate and we want to get a deal done. To Basim's point, what I think most people don't realize is everything that goes on behind the scenes. It's not as simple as having a conversation, getting along well, wanting to do a deal, and I myself decide, if I like the deal, I'll do it. If I don't, I won't, because obviously there's incentive involved, but there's a lot of layers that go into initial contact, initial conversation to final funding, and that's a lot of the battles that are fought kind of behind the scenes. We fight on the front lines trying to. I say fight. It's not a fight, but definitely a bit of salesmanship and just general knowledge of what's going on. But there's incentive to get the deal done. It's not that a banker wants to say no, but that there's certain regulations and standards that just need to be met.
Yeah. And another thing I wanted to kind of make sure that we talk about is that we're not just getting paid, or bankers are not just getting paid on credit deals. Okay. Most banks are wanting the entire relationship. They want the treasury. They want to even get the personal finances. They want to do your trade financing. They want to do everything. And so actually, credit is typically the loss leader. So if you think you're doing a banker a favor by just giving them your deal and not doing any of your treasury or operating
Right.
accounts, you're probably actually not benefiting him as much as you think. I mean, most bankers want the entire relationship. It's way more profitable to do just treasury because the risk involved with it is much less, and the competition is less. And so most
Right.
bankers, we talk about having the entire wallet share. We want our clients' entire wallet share. We want to help manage their business on the treasury side. We want to help with everything. And to the extent that we can really make ourselves a true partner with our clients and kind of advise them on all these different parts of business, that's going to make it a little bit more profitable for the bank, but it's also going to help us give in certain areas for our
Well,
clients.
right. The margins nowadays, as price competition over the last several years has just ramped up, we're not talking about hundreds and hundreds of basis points in differential from one bank to the next. We're all generally swimming in the same pool, but to that point, it makes credit a lot less profitable overall. That's the first point. The second point is the reason we really strive for the full relationship is so that we can benefit you, the client, from a relationship pricing standpoint. We have a lot more leverage and room to negotiate and maneuver when we know we have the whole relationship, because we can price everything accordingly. And that becomes a very important piece of the puzzle. I think oftentimes it's met with a little opposition from the client side that, why should I have, a lot of clients view that as a very risky proposition to have everything with one bank. When we're talking about big banks and big institutions, especially, my bank, our balance sheet is incredibly healthy. We can take everything on. I'm not going to say there's no risk, but it's a very safe proposition that benefits you, the client, when we can have everything. We can have, as Basim points out, the wallet share, where we are making money, we're profitable in the relationship, but we can extend that savings to the client as well. And that's why we always look to house as much internally as we can, so that we can offer the best possible price. And it's a win-win for both sides.
And we'll probably do another podcast just on how we price deals and how we price on relationships, just so people
I
can kind
agree.
of get to
Yeah.
understand all the nuances that go into that. But what you're saying is is exactly spot on. I mean, if we have the entire relationship, we're going to know that that's important to you, or we're going to know that what's important to us, and we're going to know that we're going to cut in areas that maybe we wouldn't be able to cut. If you come to me with just a credit deal and you say, do this for me, well, I have to make some profit on that deal, or else we're not going to get it done. But if I have your treasury and all this other stuff, I might actually lose money on your deal because it's not a big portion of the overall relationship. But because we value the relationship, we want to do what's right for you and most competitive. We're gonna price it in it accordingly. So I think,
Mhm.
like you said, from a client's perspective, sometimes they feel like it's risky to be all in with one institution. But most of the clients that I have that are all in with one institution actually have a better experience than having a split relationship amongst them a lot of banks.
Correct. Yeah. Why? Nobody wants that. Nobody wants to write down all their passwords for 8 different,
Yeah.
websites and accounts. And what that really, drills down to is sometimes you need to really take that into account and internalize it. Is at times pay for the relationship that you want. Where Besim and I working, we have a dedicated podcast for this. Is what are you paying for? What are you getting? When there's an issue, we have a very small localized team, and Besim and I operate the same way. If one of our clients has an issue on any spectrum of the relationship, be it credit, treasury, administrative, and so on and so forth, there's one person you can call. I mean, obviously, the team, you can call anyone within that team, but you can call us directly and we will handle it. Now, there's a degree of, I don't want to say cost associated to that, but, it's kind of, to a degree, pay for quality. If you just want the transactional relationship, or you work with a lender that just wants to get book the deal and then send it on to some central servicing location, which does happen, by the way. I hope you don't have issues going forward, because getting an answer or resolution to those issues can be just as tedious as getting the loan funded and approved. Whereas with our approach, which is much more decentralized, we work in the market. We are part of the market. If you have issues or want to talk through something, be it advisory or otherwise, you can reach us directly. And there's a very intrinsic value to that. Some clients really, really want that. I had a client that moved to Houston a year or so ago, and their biggest ask, it wasn't even pricing. It wasn't how much they were going to pay for the service and so on and so forth. It was having a local guy that they could call and interface with in person to go over issues, have a face-to-face conversation and talk. And it's one of my best relationships, because that's exactly what we do, and it's exactly what they want. It's not for every client. Every client doesn't want that. But I would say by and large, most clients want that close personal contact and touch, where you need to worry about your business. Let us handle the mechanics and the inner workings as it pertains to the bank relationship. And that's something we love offering.
But by and large, I would say most banks are trying to align the banker's incentive with the client. They
Correct.
want to help bring on companies that they're going to be able to help grow, and then they want to help pay the banker for that growth. And so I would just say that in general, the banker is probably on your side of the table more often than not when it comes to a deal. They want to try to get it done. They are going to get paid more if they get your deal done. They're incented to do that. They're going to be paid more if you are a long-term sticky customer. The two things that are going to probably hurt the client, hurt the banker the most, and tell me if I'm wrong here, Adam, but one is going to be losing an existing customer.
Mm-hmm.
And the second thing is their deal going bad.
Correct.
So what a banker wants to do to make sure that he can maximize his pay is bring in new qualified long-term customers and not lose existing ones, and not have any of their good deals go bad. If he's doing that, he's probably in a pretty good position. And that's what most banks are trying to create their incentive structures around, is to help bankers do that thing. Because if a deal goes bad, we've talked about this so many times, if a deal goes bad, they have to do so many deals to replace it that they're going to get penalized for that. And then if they lose a client, same thing. They're going to have to bring in maybe multiple clients to replace that, because it takes a while to ramp up, and it takes a while to kind of fully get entrenched with your client and get to know them. So those are the two things that I would say would hurt a banker most. Is there anything else that you would add to that?
No, I mean that's spot on. I'd agree with that, and that's why we have a vested interest in being your partner for the entire journey, just so you can be with us long term, grow, meet your goals and needs, and as Basim pointed out, it benefits both of us.
Yep. Well, I think that gives you a little bit of a peek behind the curtain. We didn't really get into the exact numbers and whatnot, but in general, most
You don't want
banks.
me to get my paycheck? I'll go
Oh
get
yeah,
it.
I thought you were gonna post that after.
Yeah. I think I get e-deposit now, so I'm sorry I don't
But
have a physical copy.
Yeah, I mean, but for the most part, bankers are getting a good base salary, and then they're getting, I would say, on average, 50% or more than an incentive if they're doing well. And
Correct.
so they want to participate in that, and they want your deal to get done. So just know that for the most part, most banks have it kind of aligned, and don't be afraid to ask. I mean, they're probably not going
Mhm.
to tell you exactly what they're getting paid, but I mean, they'll definitely talk to you about the structure. I mean, if that's a concern for you, I mean, it'd be something that I would recommend that you ask if you're interested in it. Um, we're gonna talk about a lot more topics. This is fun stuff for us to talk about. We're going to peel back the curtain as much as we can. So if you have questions, if you have suggestions on topics, etc., feel free to drop us a note. Until next time, Adam, we'll sign off.
Yep. We'll see you on the other side.
All right, great. Thanks, guys.
All right. Bye.